faithfully delivering value, interpreting great books worldwide. Hello, this is Sally's Book Club. Today we're exploring Pricing the Future, subtitled The Quantitative Finance History That Shook Wall Street. This book discusses a crucial finance concept: options. Period. Key means a future date, right? Quan means the right for a future date. Combined, these characters mean future choice rights. Trading options is now vital in financial markets. Since it involves trading, there must be a price. How do we price options? This question has long puzzled finance professionals. For centuries, countless brilliant minds have struggled to find the answer. Whoever solves this will become an academic superstar and earn enormous wealth. Well, this book traces scholars' exploration of option pricing and explains their mechanisms and valuation methods. The author, George Spiro, started as a math PhD, became a journalist, and authored math pop science books like Kepler's Conjecture, The Secret Life of Numbers, and Poincaré's Prize. His writing avoids complex formulas, focusing instead on the most essential and fascinating parts of mathematical stories. Pricing the Future has 18 chapters chronicling options history, highlighting key scholars and analyzing their theories. This discussion has two parts. First, we'll cover options' fundamental nature. The second part examines how people researched option pricing. First, let's closely examine the term option. Textbook definition. An option is a contract granting specific rights. It allows buying or selling something, commodities, stocks, etc., at set times and prices. Admittedly, this still sounds abstract. Let's review options' historical development to see how this concept emerged. Actually, option-like concepts appeared early in human societies. Ancient Romans used similar ideas in commerce. Historical records show that around the 1st century AD, ancient Jews also used similar methods for trading with other regions. However, options truly came into prominence only in the 17th century. That's when Europe witnessed a famous economic event, the Dutch tulip mania. In the early 1600s, the Dutch imported a new flower from Ottoman Turkey, the renowned tulip. Oh, with its beautiful form and vibrant colors, it quickly became a favorite among nobles and wealthy merchants. So tulip bulb prices soared, and tulip markets sprang up across the Netherlands. Everyone from the rich to ordinary citizens joined the tulip craze. Some even sold homes and land to buy precious bulbs, with rare varieties fetching astronomical prices. One variety, called Semper Augustus, was worth as much as a grand estate. Clearly, by then, people weren't just valuing their beauty. They traded tulips to profit from rising prices. Though immediate trading wasn't always possible. Bulbs were dug up in early June and had to be replanted by September. So actual trading lasted only 3 to 4 summer months. But traders didn't rest during off months. They signed contracts specifying next summer's tulip varieties, quantities, and prices. Today we call this forward contracting. While differing from modern options, this contained their core element: future-dated trading rather than spot transactions. The tulip bubble intensified. Obviously, this frenzy couldn't last in February 1637. The bubble burst, and bulb prices crashed. Traders were left with worthless bulbs and piles of contracts. Nationwide, people gathered at government offices seeking help. To mitigate losses, the Dutch government urgently decreed that buyers could void purchase obligations by paying sellers a 10% penalty fee. In other words, buyers wouldn't have to purchase overpriced bulbs the next year. Instead, they'd pay the penalty. They need to give the seller some compensation. Predictably, this outcome won't satisfy everyone, but at least it provides a buffer for both buyers and sellers. At this point, forward contracts evolved into what we now call option agreements. Note the key difference. In forward contracts, the trade is mandatory. Once the contract date hits, delivery must happen. With the Dutch government's legal tweak, buying next year's flowers became a right, meaning you could skip it, leaving the bulbs with the seller. The buyer just has to pay a penalty, which can also be called a premium. The Dutch tulip mania didn't just fade, it boosted awareness of speculation risks and spread the idea of options. What really pushed option trading forward was the growth of ocean trade later on. In the 17th century, routes to Asia opened, and shipping companies sailed east to buy spices and other pricey goods, hauling them back to Europe for sale. These fleets faced huge risks like shipwrecks and pirates, but raked in massive profits. One of the most famous players was the Dutch East India Company. This company focused on ocean trade from the Netherlands to India, Southeast Asia, and beyond. Backed by the Dutch government, it had major privileges. It not only held monopoly trade rights, but could even raise its own armies and wage small wars. To fund its ocean trade startups, it became the first company ever to issue stocks, backed by government credit and fat trade profits. Understandably, the Dutch had strong faith in investing here, making its stocks great collateral. In other words, borrowers could pledge their East India Company stocks to secure cash loans. So here's the problem. How should the loan parties price that stock? Loans usually have a term. Say someone borrows $100, pledging stocks worth $100 now, with repayment due in a year. But how can you be sure the stock will still be worth $100 in a year? Even though the Dutch East India Company was generally solid, if something like a shipwreck or war hit, its stock price would surely drop. If the stock's only worth $80 a year later, the borrower will likely default rather than redeem it. It's not a private strike for me. To protect lenders, the stock options market emerged. Here's how stock options trading works. Suppose news breaks that the company's fleet is returning loaded with spices, expected to dock in a month. Based on this, Xiaoming predicts rising stock prices, so he approaches Xiaogang, who agrees to accept a premium. Say $10, promising to sell Xiaoming shares at $100 per share in a month. So what happens next? Two possibilities. First, the fleet arrives safely, and stock prices climb above 100. Say it jumps to 120. Though Xiaogang got the 10 yuan premium, he must now sell shares to Xiaoming for just 100 each. Xiaoming can then sell those shares on the market for $120, making profit. Second scenario, the fleet doesn't arrive, maybe even sinks, so stock prices plunge below 100. Now, Xiaoming does nothing. He won't buy at $100 because an option is a right, not an obligation.
So Xiaoming only loses the 10 yuan premium but avoids bigger losses, while Xiaogang pockets the premium.
Thus, through options trading, Xiaoming hedges against stock crash risks. In other words, Xiaogang gets the premium, Xiaoming gains the option. Plus, options aren't just for stocks. They work in commodity trading too.
For example, on March 1st, a baker buys a flour purchase option expiring April 1st. Strike price 50 yuan per kilo.
He pays the broker 1 yuan as the option fee. If flour drops below 50 yuan, the baker lets the option expire, buying cheaper elsewhere, while the broker keeps the premium. But if flour hits 60 yuan, the baker demands delivery, paying only the preset 50 yuan price. So it seems options are quite useful, significantly offsetting the impact of commodity price fluctuations. So the question arises, how much should this option premium be worth? Or put another way, how do we price an option? Initially, it relied on intuition or mutual agreement, without rational guidance. With stock exchanges emerging in France and elsewhere, research in finance grew, and gradually, people began attempting to rationally price options.
In the second part, we'll discuss the history of research on option pricing.
There are 3 key milestones, each with its representative figures. First is a Frenchman named Louis Bachelier. Bachelier worked as a clerk at the Paris Stock Exchange, but he loved mathematics, so he quit and went to Sorbonne University to research, completing his doctoral thesis in 1900. In this thesis, called Theory of Speculation, Bachelier proposed an important view, that stock price changes follow a normal distribution. We've all heard of the term normal distribution to some extent. It describes a statistical phenomenon. In daily life, normal distribution can be observed in many things like people's height, weight, IQ test results, etc. If you plot the probability distribution of these metrics, It shows a characteristic of dense in the middle and sparse on the sides. The reason normal distribution is so universal is because it has a mathematical foundation. That is, when many independent random variables combine, their interaction results conform to normal distribution characteristics. For example, a person's height is determined by many independent factors. These factors include father's height, mother's height, nutrition, environmental factors, etc. When these factors are combined, they form a height that follows normal distribution. Similarly, Bachelier pointed out that stock prices are influenced by various events, like wars, governments, new regulations, public opinion, impediment, etc., which are diverse and unpredictable. Therefore, the market price of stocks fluctuates around their true price, also following the pattern of normal distribution. Why is Bachelier's contribution important? That's because if we can describe stock price changes with a normal distribution, it means the stock market can be analyzed through mathematical methods. As he himself wrote in his paper, the market unknowingly follows a law that governs it, the law of probability. In Bachelier's era, financial markets were just emerging, and people's understanding of finance was quite subjective. Bachelier combined mathematics and finance, turning finance into a discipline that could be quantitatively analyzed. Armed with mathematics, Bachelier began to tackle the challenge of option pricing. He used data from his time at the stock exchange to build mathematical equations linking stock prices and other factors to option prices. Ultimately, Bachelier deduced that an option's fair price depends on time and stock volatility, meaning higher volatility and longer time to expiration lead to a higher option price. This was the first scientific derivation of option pricing in financial history. It's impossible to overstate the importance of this paper. Although Bachelier was brilliant, his theory was too ahead of its time, so his work didn't get much attention back then. It wasn't until over half a century later that another famous American economist took up Bachelier's baton, Paul Samuelson. In option pricing research, Samuelson's key contribution was refining a major assumption in Bachelier's work, proposing that stock returns, not prices, follow a normal distribution. So, the question arises, how should the loan parties price this stock? Like Bachelier, Samuelson also aimed to understand financial issues using mathematical methods. As an aside, Samuelson was one of the 20th century's most influential economists. His research spanned microeconomics, and more, and he became the first American to win the Nobel Prize in economics. When Samuelson focused on option pricing, he highly praised Bourgeois' approach, but pointed out a flaw. Bourgeois' key assumption that stock price changes follow a normal distribution. Samuelson pointed out that starting from this assumption, Bachelier's model would lead to unexplainable contradictions in certain scenarios. For example, in Bachelier's assumed price distribution, the mean was zero, meaning half the price changes were positive, half negative. But if a company's stock kept losing value for many days, prices moving continuously negative, it could theoretically make the stock price negative too. We all know that in normal trading, the worst case loss is the stock hitting zero. It never goes negative. Bachelier actually recognized this obvious contradiction but didn't solve it. Clearly, Bachelier's normal distribution assumption for price changes was wrong. His model needed adjustment. But how? In 1958, an American scholar named Osborne proposed a solution. Osborne suggested that when trading stocks, investors care more about proportional price changes than absolute dollar amounts. For a $100 stock versus a $10 stock, a $1 rise means completely different things for these companies. Osborne based this view on psychological research. This research showed that human perception of stimuli changes based on relative increases, not absolute ones. Like having testers carry rice sacks blindfolded. If starting with 1 pound, they'd notice adding just 0.1 pound. But starting with 10 pounds, they'd only notice after adding a full pound. Osborne argued this applies to how people perceive wealth changes too. Samuelson agreed. Both believed we should measure price changes in percentages, returns, not absolute dollars. This would solve Black-Scholes' absurd negative price problem. Using percentages, even continuous crashes, won't make stock prices negative. A stock initially priced at 100 yuan, after 12 consecutive 10% drops, will still be worth 28 yuan. If the stock price drops by 10 yuan each time, it only takes 11 consecutive drops to make the price negative. Although replacing simplicity of solution with the rate of return seems simple, it resolved a key contradiction in Black-Scholes' model. And it also more realistically reflects the actual situation in the stock market. The work of Samuelson and Osborne improved upon Black-Scholes' theory.
But this model still has many shortcomings. When fitting it with extensive experimental data, the results aren't ideal.
To truly find a method for pricing options, more factors need to be introduced. In this third stage, the key figures are the American economists Fisher, Black, and Scholes. Their contribution was in introducing the concept of risk hedging and ultimately deriving the option pricing formula.
So what exactly is this risk hedging?
Let's break down their thinking step by step. First, Black, as a math PhD, was interested in finding an option pricing formula, but his approach differed from predecessors. He chose to re-examine it from a perspective of return and risk. We all know a simple principle. Risk and return are positively correlated. Higher risk means higher return, and vice versa. Therefore, an option's return should be related to the risk it bears, which was Black's starting point. So how do we assess the risk faced by an option? This was a problem Black couldn't figure out. Later, Black met economics PhD Myron Scholes at work. After learning of Black's ideas, Scholes was intrigued, and they began collaborating to develop a solution. And the key to it was risk hedging. And risk hedging means you have two assets whose return fluctuations are opposite. When one falls, the other rises. As long as their gains and losses balance out, you have no risk of loss. This concept is also common in daily life. The simplest example is if you open a shop. You can sell both sunglasses and umbrellas. On sunny days, sunglasses sell well, but umbrellas don't. On rainy days, sunglasses don't sell well, but umbrellas do. Creating this hedge ensures you always have sales regardless of weather. In Black and Scholes' view, options are essentially a hedge against stock risk. In reality, you can simultaneously buy a company's stock and its put options. Put options simply mean you profit if the stock falls. If the stock price rises, you gain on the stock but lose on the put option. If the price falls, you lose on the stock but gain on the put option. By combining stocks with a calculated number of options, these offsetting movements create a risk-free portfolio. The brilliance here, introducing hedging lets us derive option risk from stock risk, then determine fair pricing. For stock analysis, they use Samuelson's improved model where stock returns follow normal distribution. This formula became known as the Black-Scholes model. Using it, you input stock price, volatility, option duration, risk-free interest rate, and it calculates fair option pricing instantly. In May 1974, they published The Pricing of Options and Corporate Liabilities, which quickly became one of economics' most important papers. As of late 2021, this paper has been cited over 40,000 times. Remarkably, just 1 month before their publication, the Chicago Board Options Exchange, CBOE, launched in the U.S. This was America's first standardized options exchange. The exchange soon adopted the Black-Scholes model as its standard pricing mechanism. After this extraordinary research, both scholars achieved remarkable career success. Black became a partner at Goldman Sachs. Scholes taught at Stanford and other top institutions, winning the 1997 Nobel Prize in Economics. Tragically, Black died of cancer shortly before the award, narrowly missing the Nobel recognition. In this section, while only Black-Scholes, Samuelson, and others are mentioned, countless scholars throughout history contributed their wisdom to option pricing. The option pricing formula by Black and others was formally established. Building upon these predecessors' research, they ultimately succeeded. Of course, nothing is perfect. The Black-Scholes formula also has its limitations. For example, the model assumes no transaction fees, but in reality, fees are unavoidable. Another key variable in the formula is stock volatility. People use historical stock price volatility as a proxy, but this isn't entirely reasonable since future volatility changes. And a bigger issue is the normal distribution assumption. Black and others adopted Samuelson and Osborne's revised normal distribution model, where most changes fall within the main curve. Thus, the model works well, mostly, but tiny probability events still occur at the distribution's edges. And in stock markets, what's truly unpredictable are these small probability events causing massive surges and crashes. These are what we call black swan events. Later, a famous company called Long-Term Capital Management, LTCM, stumbled in the market. Their profit strategy was use option pricing formulas to calculate fair value, then find mispriced assets for arbitrage. In less mature markets, option pricing often deviates significantly from fair value. Relying on this method, LTCM earned huge profits and briefly became a financial markets star. However, an accident occurred during their Russian government bond trades where they'd placed heavy bets. In Russia, unfortunately, in 1998, due to worsening economics, the government unprecedentedly defaulted. They failed to pay bond interest, causing massive market panic.
So people dumped Russian bonds en masse, catching LTTM off guard. They lost $550 million in one day.
As panic spread, more investors fled the Russian market, but long-term capital management, being too big to turn quickly, lost 50% that year, nearly going bankrupt. Later, the U.S. government led a bailout with over a dozen major banks, saving this financial giant. All right, that wraps up the book's content. In this discussion, we've learned that options are essentially rights, letting you decide whether to buy or sell commodities or stocks in the future. To get this right, we pay a premium, and countless scholars have researched how to price options. Bachelier introduced probability theory. Samuelson and Osborne proposed stock returns follow normal distribution. Finally, Black and others approached it through risk hedging and completed the pricing model. Through centuries of scholars' joint efforts, option research has continuously evolved. Of course, current option pricing formulas still aren't perfect. Financial markets face unpredictable extremes, meaning we may never accurately price the future. But perhaps that's what makes trading and investing fascinating. Well, that concludes our exploration of pricing the future. Reading notes are below the audio. See you next time.